Welcome back to the Microlearning Institute. In this tutorial we look at IFRS 2 share-based payments, and we look at how to account in respect to IFRS 2 for cash settled share appreciation rights. Now, you may remember from previous studies that for a cash settled share-based payment we recognize a liability to the statement of financial position at year end. And how we calculate that liability is we multiply the estimated number of employees who are entitled to the cash settled share-based payment by the number of instruments per employee by the fair value of each instrument at each year end, and we time apportion that over the vesting period, and we take a corresponding movement to the P&L. So in example 5 we're told that an entity grants 100 cash share appreciation rights, or SARs, to each of its 500 employees, on condition that the employees remain in its employ for the next 3 years. During year 1, 35 employees leave, and the entity estimates that a further 60 will leave during years 2 and 3. Now, we're also told that the entity estimates that the fair value of the SARs at each year end in which a liability exists is as per the table here, and at the end of year 3 all SARs held by the remaining employees will vest, and the intrinsic value of the SARs at the date of exercise, which again is equivalent to the amount of cash that we had to pay out at the end of years 3, 4 and 5, is also shown. So here we have a table with the fair value of the SARs and the intrinsic value of the SARs for the 5-year cycle of this question. So when we look at year 1, we say that we had 500 employees, and we anticipate that a total of 95 of them will leave. They're all going to be entitled to 100 SARs, and again the fair value of the SARs at year end year 1 is $14.40, and of course we time apportion this liability over the vesting period, which is 3 years. So the cumulative liability that we recognize to our statement of financial position at year end year 1 is $194,400, and of course we recognize a corresponding P&L expense. We're told that during year 2 40 employees leave, and the entity estimates that a further 25 will leave during year 3. So again we can see we started with 500 employees, 35 left in year 1, 40 left during year 2, and we anticipate that 25 will leave during year 3. So that number of employees, the net number of employees, will be entitled to 100 share appreciation rights. The fair value at year end year 2 from the table we showed earlier is $15.50, and of course we time apportion the cumulative liability over 2 years with respect to the 3 years of the vesting period. So the cumulative liability that we now recognize year end year 2 is $413,000, and again we need to recognize an incremental expense to the P&L of $218,933. During year 3 we're told that 22 employees leave, and at the end of year 3 150 employees exercise their SARs. Another 140 employees exercise their SARs at the end of year 4, and the remaining 113 employees exercise their SARs at the end of year 5. So let's look at year 3. Firstly, in terms of SARs exercised, we had 150 employees who exercised their 100 SARs, and again the intrinsic value of each of those SARs, we're told in the original table, is $15. So that equates to an expense of $225,000. Outstanding SARs are the 500 less the 97 employees that have left, less the 150 SARs that were already exercised at year end year 3. So that's the number of SARs that are outstanding. By $100, by 100 SARs each, by 1820, which of course is the fair value of the SARs that are still outstanding. So we must recognize cumulative liability to the statement of financial position of $460,000, and that equates to a total expense of $272,127 to the P&L. Now, similarly, when we look at year 4, we're told that 140 employees exercise their SARs, and again the intrinsic value of those SARs is $20, and of course outstanding then will be an outstanding number of SARs and we're told that the fair value of those SARs at year end year 4 is $21.40. So the cumulative liability at year end year 4 now goes to $241,820. So the SARs that were exercised, for which we actually wrote the checks in cash, totaled $280,000. So consequently, in order to achieve the right balance, we need to recognize a credit to our income statement of $218,640 in relation to outstanding SARs. That leaves a net expense in year 4 of $61,360. Finally, in year 5, we want to finish with a statement of financial liability of 0. The SARs that were exercised, which is 113 SARs were exercised, gave us an expense of $282. We need to eliminate the outstanding liability from the year end year 4 because we want to reduce our liability to 0. So consequently, the net income statement expense that's recognized in year 5 is $40,680. Thank you very much for looking at this tutorial from the Micro Learning Institute in relation to IFRS 2 share-based payments.